One of the harshest critics of the Fed, former Texas Congressman Ron Paul, had this to say just moments ago. Take a listen.
They do not rescue a bad economy, and when they try to, they just prolong it. And just look at, what the central bank did in Japan, and look at what they're doing here in this country. And, things aren't really that much better in spite of their so-called favorable statistics. We still have a lot of problems.
He's right about that. Let's bring in Capitalist Pig portfolio manager Jonathan Hoenig and Lido Isle advisor president Jason Rotman. Thanks to both of you for joining us. I mean, he talks about getting rid of the Fed. A while ago, I think a lot of people thought he was crazy, but you look at what's going on right now, and the Fed has created these distortions. We've seen a market run up. At the same time, they haven't achieved what they wanted to do. We have no inflation. I mean, they can't get any velocity of money going at all right now. And you have Janet Yellen going out there saying things in defense of this that are factually incorrect, like the fact that the loose monetary policy has put people back to work and has reduced income inequality, when we know from census data it's increased income inequality. Jason, what do you think?
You make a great point there, and I think it's all true. I think my main point, though, not necessarily to combat you, but just in addition to everything you said, which I love, is the fact that the Fed has too much power. And I think I side with Ron Paul, at least in that. Listen, the Fed has driven the market higher, and now they may, maybe drive the market lower if they actually start to raise rates ever, but who knows if they will. The point is that we need to be, see, the thing is, the election next year is perfect timing, you could argue, because these candidates need to convince all of us that, listen, politically, they can actually help the economy get back on track. We don't just have to rely on the Fed.
Yeah. Jonathan,
Melissa,
go ahead.
Prices are not arbitrary. You don't pick them out of a hat, not for wages, and certainly not for interest rates. And that's what, the interest rate environment in this country has become. It has become a political animal. And for those of us who are trying to make money in the markets, the Federal Reserve has become it's a complete total mystery. It's arbitrary, it's subjective, and if you look at some of the Fed's language today, it now not only seems to be influenced by its mandate here in America, but its supposed mandate worldwide, as they're citing, for example, weakness in Canada, weakness in China as reasons for keeping these rates at unnaturally low levels.
John Lunsky, he makes the best, most simple point. Prices are not arbitrary. They're not supposed to be.
But here we're talking about the price of money, and how do we determine what is money? Some years ago, the Fed relied on they targeted reserves. They targeted the M2 measure of the money supply, but they quit doing that because it proved to be ineffective. If the function of Fed policy is to try to influence the cost of money, they have no choice but to turn to Fed funds and occasionally use quantitative easing. I think that's the crux of the matter. Money is different from other goods and services.
But Liz,
I have to say,
go ahead.
I disagree. Money, like any commodity, is determined in a free market through supply and demand and free trade. And interestingly, Melissa, the price of money had actually been rising this year almost steadily before the Fed stepped in here. The 2-year, the 5-year, and the 30-year U.S. Treasuries have all increased in rates, even without the Fed doing anything. So the market itself,
Wait a minute. You're wrong, because the latest 10-year Treasury of about 2.25% is well under its average when we had quantitative easing 3. So the Fed has done, and yet the bond yields went lower.
The problem with this that Ron Paul has, Liz, I think, is that we are not supposed to be having someone out there deciding what money should be trading at, because who do we trust to have that wisdom? We have somebody in charge, Janet Yellen, right now, who is saying things in this press conference that are factually incorrect and crazy, and it's scary to have that person determining the price of money. That's the problem with having a person in charge of the Fed and deciding what money is worth rather than letting market forces take over. Do you disagree?
I think there is a committee involved, and I think they take input from all different kinds of things. I do think when you start looking at Chinese market valuations and that comes into the consideration, I think there's a pretty good argument to be made that the Fed's kind of mandate has gotten bigger and bigger, and it's supposed to be quite narrow. And I think that's something that Janet Yellen has been involved in. What I don't like is this tease. Again, she has teased the idea that we're going to be raising rates. And remember, what she was talking about was slow and steady, 0.25% interest rate hike, which would maybe even over 4 quarters, you're talking about 1%. I mean, to me, that was a pretty reasonable idea to sort of start heading us back towards normalcy. And now, I mean, now we're kind of right back where we were, and I think you'll see market volatility as a result of it. I thought it was a bad decision.
Ben, let's let Ben get in here. Ben, I mean, she's reacting to what potentially may happen down the road elsewhere and keeping it in an emergency position where we're sitting here at zero. I mean, we're not talking about, not raising it even further beyond what it is. We're at an emergency stance when there is no emergency going on.
Well, I wouldn't call it an emergency stance because we are at 0%
What's lower than
interest
zero?
rates. But we are not doing quantitative easing anymore. And I should emphasize that the alternative to what we saw today was a so-called one-and-done, quarter-point rate rise, after which we were going to sit tight for another half year or so to see how the economy digested it. That, to me, made no sense whatsoever. If inflation is really an imminent risk, then you don't do one and done. You start raising rates and you focus on keeping inflation down. But inflation is not the problem right now. It's well under the Fed's target.
I think a lack of inflation is the problem, John Lonsky.
That's right. And the bond market is telling the Fed to keep short-term interest rates at very low levels. I mean, we have the Treasury bond market putting yields down, levels that haven't been seen at this stage of an economic recovery in the past. We had the federal funds futures market that was telling the Fed not to hike rates ever since we've had this latest bout of global financial market instability. So I think it's wrong to state that the Fed comes up with these interest rates out of thin air. No, the Fed is very much taking guidance from the behavior of bond markets, the Treasury bond market, the money market.
Jonathan, hang on. Jonathan, last word to you, and then we're going to go. Go ahead real quick.
Well, the rates are set out of thin air. I mean, we all, gather around like when they decide a pope and wait for the puff of smoke to come out of the hut. I mean, what's so frustrating, Melissa, is that it's easy to figure out how many Frappuccinos Starbucks is going to sell or how many Fords, the company is going to sell. But what this arbitrary committee is going to decide about the price of money, that's impossible.
Okay, we got to leave it there. I know John Lonsky can't even take it. He's bursting.
The dollar exchange rate has been strong.
We got to go. We got to break. David, go ahead.
The market is pleased with the Fed's performance.